Okay, just finally, I'm going to wrap up on a couple of the more common scenarios or the things to be watch out for if you're involved in property transactions, or if you're being asked to look at a property transaction. Does transfer of business, is it applicable? As I said, it's mandatory, so if it applies, it applies. If the purchaser's deduction would be denied, not really the vendor, but the vendor would, if the property was less than 5 years old, then it's the vendor will be held liable if he applied transfer business and it wasn't transfer business. So it can cut each way. The other thing, just to say to you on a transfer business, so if you sell a property that is less than 5 years old, the first sale of a property that is less than 5 years old as a transfer business under the transfer business rules, well, then you don't pass a capital good record in that situation, because that sale would have been mandatorily VATable, both for the transfer business, and a new capital goods scheme will kick in that scenario. But again, not something you come across very often, but just be wary of it. The joint option to tax for taxation creates a new 20-year VAT life for the purchaser. Is it the right thing to do? Is the purchaser happy to carry the burden for 20 years, or would he be better paying an amount of compensation? If there's only a couple of grand left, if there's only 2 or 3 periods maybe left in the adjustment period, and it doesn't equate to a whole lot, it might suit the purchaser, give them more flexibility as to what they can do with the property going forward in terms of who they can lend it to, etc., etc. So just to bear that something to bear in mind if you're looking at the joint option to tax. Particularly from the purchaser's point of view. I mentioned on Friday, if you do decide, or a purchaser does decide to pay compensation, well, then that compensation is additional consideration for the sale. For CGT or what other tax purposes, it's not a VAT, although it is triggered by or determined by a VAT calculation. It's not VAT. I mentioned that the receivers and etc. can't opt the tax, can't use a joint option in connected party sales. Again, so connected person sales outside the receiver. So if you have a connected party sale outside of the receiver situation, well, then there are certain the VAT on the sale must at least equal the VAT, or the remaining VAT life, the remaining residual VAT in that property. So if you had two connected party selling to another connected party wanting to use the joint option or whatever, the VAT that's accountable for in respect to that sale must at least equal the VAT that's remaining in the VAT life. So you have to have a look and say, what is the residual VAT? So maybe it's 10 years gone or whatever. So it's 50% of the VAT that was reclaimed originally remaining in the VAT life. Well, the VAT on the sale must at least equal that. If it doesn't, the vendor suffers a clawback for the difference between the two figures. But that can be avoided if the purchaser agrees to take over the capital good record. So if you transfer it, regardless of your price, if you transfer it and the purchaser agrees to take over the capital good record and the obligations, well, then that clawback doesn't arise. So again, something to bear in mind. Any connected transactions really in tax generally, particularly in VAT, you need to be a little bit wary when you're looking at them, but there are ways around them. That's the other scenario. So the transfer business, the CGR passes, and also in that scenario, which I think I've come across once ever, the CGR passes as well. If you're letting a property to a connected party, you just need to make sure that they have 90% VAT recovery. Otherwise, the option to tax automatically cancels, so it or is invalid from day one in that situation. VAT clause in the lease, but that goes without saying. More generally, you must ensure the valid option to tax. So if you are going to joint option to tax, it is a joint option. On a sale, it's a joint option to tax. If you're going on the landlord's option to tax, you want to make sure that it is recorded. In the joint option, obviously, it needs the agreement of both parties. So the clause in the contract is the way to do it. Technically, it doesn't have to be a clause in the contract. You can do it by side letter with both parties having signed or something like that. The The landlord's option to tax is a little bit more flexible in terms of, again, it is made, the landlord's option tax is made by the landlord making a definite statement to the effect that he's going to charge VAT. Now, the revenue will accept, the revenue have accept situations where the actual landlord issued a VAT invoice showing VAT on the rent, and they've accepted that as being a valid option to tax. So not quite as strict on the landlord's option to tax in terms of lettings as to the joint option in relation to the sale transaction. And then the other one to be careful about then is the refurbishment capital good created by a tenant. You know, whether you want to take that over or not, unless there's a clause in the contract that commits you to taking it over. You know, I would certainly be advising any landlord. I'd be advising not to take on such a clause, because if you're going to let the property to somebody, the next tenant, who may be somebody who's VAT exempt, an insurance company or something like that, who are VAT exempt, all you're doing is creating another VAT cost for yourself in terms of capital good, because as well as the normal capital goods gain on the property, you will also be liable for the capital good liability arising from the tenant's refurbishments, which you never really benefit from in the first place. So be careful with that. But again, if you're going to let it to somebody else who's going to be valuable and you're going to charge VAT, well, then yeah, I don't have a major problem. It might be too long left in the refurbishment capital good or whatever. But you just be when you're advising your clients, just be aware of the implications of taking on a tenant's capital good.